Welcome to Inside India. I'm Amitabh Singh, and these are your headlines. NVIDIA sees no signs of an AI slowdown, delivering a beat and a bullish outlook. And Jensen Huang calming nerves about an AI bubble.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different. As a reminder, NVIDIA is unlike any other accelerator.
We will get Morgan Stanley's take on all of that. Martin Soong is on the ground at the bank's APAC summit in Singapore. Martin?
Good morning. Yes, we will. NVIDIA also will talk about two big investment scenes. We're going to be sitting down with Steve Bird, who is head of global thematic research at Morgan Stanley, about AI and power. Not enough of it. Also, the building back up of defense industrial bases around the world. What are the opportunities for investors? That's coming up.
And the Nifty looks set to build on its gains after reclaiming that 26,000 level amid the broader gains all across Asia. All right, a look at the Asian markets. It's NVIDIA-driven positivity, the stronger than expected earnings and good forecasts, reinforcing confidence in the global AI trade. Take a look at that. In just the last couple of seconds, the entire board has gone green. That's what you're seeing as Japan's Nikkei really leading that charge, along with the Kospi, jumping in early trading and maintaining that 3% across both the Kospi and the Nikkei. Remember that it's the sentiment that has come from the US and, of course, with NVIDIA. That's the Asian market sentiment that's really playing out there. Tech conglomerate SoftBank skyrocketing as much as 8%. Some of the other tech companies, semiconductor equipment maker Tokyo Electron soaring nearly 7%. And South Korea's Kospi also clearly advancing there at 3%. The heavyweights in South Korea, memory chips makers SK Hynix and Samsung Electronics added more than 6% and 3.3%. And investors are waiting right now. So consider that, because they're waiting for that release of the US jobs report for September, which is due later in the day. And that will perhaps have a larger impact going forward in the next couple of days. Now, the Indian markets, they come online in about 45 minutes. Here's what GIFT Nifty Futures is indicating. The Indian market ending higher on Wednesday with the Sensex and Nifty raising early losses as renewed foreign inflows and a rebound in major IT names helped steady sentiment. Infosys led the charge, advancing ahead of its rupees 18,000 crore share buyback that opens today. Given the Nifty chart setup favoring bulls, we could actually see analysts say that the Nifty could reclaim that 26,100 October high. But will it really hold the psychological 26,000 zone? It depends on that. And remember, the record high is 26,300. That also can't be ruled out. Now, shares of NVIDIA popping in US extended trade after its Q3 numbers beat on both the top and the bottom line. NVIDIA has taken a hit from the recent fears around AI valuations. These solid results will calm those worries, at least for now. CEO Jensen Huang telling investors, what bubble? There is no bubble.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different. As a reminder, NVIDIA is unlike any other accelerator. We excel at every phase of AI, from pre-training and post-training to inference.
CNBC's Christina Pratsinivelos has more details of that earnings report card.
NVIDIA just delivered solid results with Q4 revenue and gross margin guides beating even high buy-side estimates. But the real news actually came from the earnings call. The CFO said the Saudi Arabia agreement alone is for 400,000 to 600,000 GPUs just over the next 3 years. The Anthropic deal is net new demand on top of that. Her key line in the earnings call was that there's definitely opportunity for more on top of that $500 billion backlog CEO Jensen Huang announced back in October. That means the $500 billion order book is the floor, not the ceiling. And another major development, the U.S. Commerce Department just authorized exports to G42 in the UAE and AI startup Humane in Saudi Arabia. Each can purchase up to 35,000 NVIDIA Blackwell chips. The approvals follow landmark U.S. Saudi and U.S. UAE AI partnership agreements, but this is really just about sovereign AI demand materializing in real time, filling the gap where China used to be. NVIDIA CEO also promising on the call the company will continue share buybacks, and that's why you did see the stock up in after hours, as these numbers are really helping calm AI bubble fears. NVIDIA just showed demand is expanding beyond what they previously disclosed. For CNBC Business News at the NASDAQ, I'm Christina Parts-Neblis.
All right, as you heard from Christina there, NVIDIA expanding its reach in the Middle East, partnering with Elon Musk's xAI and Saudi startup Humane to build a data center facility in Saudi Arabia. Humane was launched just this year and is owned by the Public Investment Fund. Jensen Huang spoke about that team up with Humane at the U.S.-Saudi Investment Forum in D.C. overnight. Take a listen.
We worked together to get this company started and off the ground, and just got an incredible customer with Elon. Could you imagine a startup company, approximately $0 billion in revenues, now going to build a data center for Elon? 500 megawatts is gigantic. This company is off the charts.
And that was just one of a slew of deals coming from D.C. during Saudi Crown Prince Mohammed bin Salman's visit. CNBC's Eamon Javers has all the details.
It involves sales of sophisticated AI chips to the Middle East, including that Blackwell chip that's been sort of on the bubble, whether or not the U.S. would allow that to go overseas or not. Under the terms of this deal, that would be allowed to be sent to Abu Dhabi, according to the reporting by the Wall Street Journal and confirmed by a White House official who emphasizes that there will be strict security checks around all this. And we heard some big numbers from the president, $600 billion up to $1 trillion. No details, no specifics yet from the White House. We don't have a list of things that the Saudis are going to buy here in the United States. Here's how the president put it.
This week, our countries also signed groundbreaking agreements on civil nuclear energy, critical minerals, and artificial intelligence. And I want to congratulate a lot of the great American leaders, business leaders that are in the room. And you'll do a great job for Saudi Arabia and for a lot of other people in the room that are buying your product, taking your product, and using your product. All of that is in addition to the $600 billion investment in the United States that Saudi Arabia announced during my unforgettable visit there last spring. Well, I said, could you try and get that up to $1 trillion? And yesterday, the Crown Prince announced that the number that they'll be investing in the United States is $1 trillion. $1
trillion is a lot of money, and it's actually almost the entire GDP of Saudi Arabia. Their GDP about 1.2 trillion. So, how that money will be deployed, where it's going to come from, where it's going to go, over what period of time, we're still waiting for the White House to fill in the blanks on some of those details to get a sense of which industries in the United States might most benefit from that Saudi spending.
It is really about filling in those blanks. Now we're heading to the Morgan Stanley APAC Summit to dive deeper into the AI and energy theme and perhaps get answers to those fill in the blanks. Martin Sung is on the ground leading our coverage from there. Martin, what do you have for us today?
Good morning, Natasha. Good morning, folks. Yeah, you're absolutely right. We've been talking about AI. It's a big theme here at the Morgan Stanley Asia Pacific Summit. And more importantly, I think this morning especially, we've had a lot of focus on it because of, obviously, NVIDIA earnings, right? Let's bring in our next guest. Stephen Bird joins us, Morgan Stanley's Global Head of Thematic Research, live. Stephen, great to see you and a pleasure having you on the show.
Thank you so much.
You've seen the NVIDIA numbers, right?
Yes.
Beat on bottom line, also on the guide. Stock is up.
Yes.
Maybe not as much as you would have expected NVIDIA to be up before after a beat, but what do you think?
This is a sign of incredibly fast demand growth in compute. And that's a sign of the nonlinear rate of AI improvement. As AI technology just gets better and better, we see a proliferation of use cases, and that means the demand for compute goes up and up and up. It looks to us like systematically the demand for compute is going to be far above the ability to supply that demand.
All right, so it's sort of like like Jackson Hole, it's a ski slope. It's almost vertical, right? Exactly. But here's the thing, to power that compute, let's get to one of the big themes that you've been thinking and writing a lot about recently, right? Power lags behind.
It does.
And we were talking offline a couple seconds ago, and I wanted to ask you whether, and I want to get your take on this as well, the competition in AI for the U.S., is it versus China necessarily, or is it versus, say, profitability? And how does power play into all of this?
That is a really important question. It is both. So let's talk about U.S. versus China, and then let's talk about profitability. We get asked both of those. We're inundated with questions, more on the latter in terms of the overall returns. China versus U.S., very different business models, very different situations. China has ample power, but less compute. The United States is very limited by power, but has a massive amount of compute. The American perspective first, and then we'll go to the Chinese perspective. The American perspective is the big 5 U.S. labs are going to take about 10 times the compute that they had last time to train their next model. And if scaling laws hold, when you apply 10 times the compute, the model that comes out should be about twice as capable. So what that means in very tangible terms is first quarter, second quarter of 2026, those American models could achieve breakout performance that others cannot keep up with because of that compute. We believe other competitors around the world just don't have that computational power. So that is the American point of view. We will get much better. That results in lower unit costs of being able to perform tasks throughout the economy. Now, let's go to the Chinese perspective, which I think is a very powerful argument. The Chinese argument is we don't need to be at the frontier. We can spend less capital and create very useful AI tools at much lower costs, very practical tools. They'll be used around the world. I actually think there is room for both models to coexist. I do think China will be able to secure contracts with customers around the world, but these American models could achieve breakthroughs that can essentially result in more parts of the economy being addressable by AI than people realize.
Okay, I hear you there, but how do you bridge the power deficit, right, to get to that kind of, or support that kind of compute in the U.S.? Because latest statistics I've seen, China generates enough electricity or power, right? They outpower the U.S., I think, 2 to 1.
Absolutely. Absolutely. So in the U.S., let's walk through that issue. So we have this detailed chip-based power model. In the U.S., we would need to build about 70 gigawatts of power between now and 2028. To put that in context, New York City is around 6 gigawatts, so 70 is a massive number. Traditional solutions won't be enough. We will be short about 45 gigawatts after we consider those traditional solutions. That said, where there's a will and lots of money, there's often a way. And so, for example, gas turbine complexes, fuel cell complexes, converting Bitcoin sites into data centers, all of these would be used. And if we're aggressive in those, we might be able to be very close to bridging the gap. But I do think we're going to be short. And so that means not every data center that wants to get built will be able to get built in time in the U.S.
So part of the solution or answer has got to be nuclear, right?
Yes.
And small modular reactors, SMRs, right? You talked about the will being there and the money being there as well. What about the laws and the regs? Are they changing fast enough to support nuclear rebuilding?
Yeah, great question. Team Trump is very supportive of nuclear. You see that almost every day. They provide a variety of nuclear support. And we will see SMR development in the United States, and that's a good thing. It's zero carbon, it's controllable, it's highly reliable. The challenge, the last challenge that we're thinking about is cost overrun protection. So I've lived in the power sector through 30 years of ups and downs, and we have seen new nuclear projects in the United States and many parts of the world be vastly over budget and behind schedule. So the sector very much wants protection against those cost and schedule overruns. We don't yet have that in the United States. That may require legislation. We're not sure we have the willpower in the U.S. for that. So that is an issue.
Okay. So that's a nice segue to the other big theme that you've been thinking, writing, and talking about as well, and that is the rebuilding of defense industrial bases around the world. Let's start with the U.S., where it's obvious. It's pretty obvious. It's pretty apparent, right? Yes. And this whole issue of the cost-plus business model with regard to the defense primes has been, well, to be put it diplomatically, I think a very, very inefficient way of deploying capital and using, obviously, at the end of the day, taxpayer money, right? How close are we to that being changed or upended by names like Anduril, which is still private?
It's a great question. So the U.S. War Department is thinking a lot about the evolution of warfare. Just last week, there was a list of 6 new technologies that the U.S. War Department wants to adapt. And this does deal, to your point, with asymmetric warfare, with very low-cost approaches to weapons systems that can cause a great deal of damage with very little capital expenditures. So I do think the U.S. War Department is thinking about this. That creates all kinds of implications. So perhaps concentrated, extremely expensive pieces of defense equipment may really be de-emphasized in favor of massively distributed capabilities. I would expect to see that. That does does put pressure, to your point, on unit costs. That does put a lot of pressure on that. The U.S. needs to adapt. It reminds me of other technologies, though, where other parts of the world come up with better, lower-cost approaches. The U.S. needs to adapt. I do see Team Trump realizing that and taking steps to adapt.
Okay. You know, we've been talking a lot about valuation and the AI trade, whether things are overstretched, right? And I mentioned NVIDIA, post this set of earnings, that's probably actually below 30 times.
Yeah.
Palantir at one stage not so long ago was about 200x. Now it's maybe about 175, 180 or so. Is that an issue or not? Or is Palantir almost a singular sort of company?
It's a great question. When we get asked about the bubble, the concept that we just don't have sufficient returns, I think it varies a lot by the business model, but let me start with a fundamentally bullish argument. When we look at the use cases for AI, we did this detailed assessment of the S&P 500, where we went job by job and looked at what AI can do, and we found that we could save about $900 billion in costs within the United States, within the S&P 500. That is absolutely dramatic from where the technology is today. And I think what investors are really missing is it doesn't matter where the technology is today, it matters where it's going in 3-6 months. And that improvement rate is nonlinear and very important. So I like that overall case. Now, that doesn't mean that every stock, therefore, is a buy across the entire value chain. What I like, I guess I come from infrastructure, it's no surprise, but I like the bottlenecks. Anybody who has compute, who has power, who has labor, who can de-bottleneck the power system to get more compute, that's going to be very valuable. The adopters are going to be very valuable, and investors have barely scratched the surface on AI adoption and the benefits, so I like that quite a bit. But some business models are riskier. Frontier model development is a much riskier business. So I'm not suggesting every company is a buy as a result of AI being so strong. I think it's more nuanced.
You know, Stephen, the way you're talking about it, it sounds as though both themes that we've started talking about, AI and power, and also building back the defense industrial base around the world, right? They're actually not separate and singular silos, right? They're actually interrelated through technology.
Absolutely. A good example would be rare earths and chips. So it's very clear that this question will continue to come up. China has significant leverage when it comes to rare earths. We know that. The United States has a leading position in terms of access to the cutting-edge AI technology. How will that evolve? So one question that comes up a lot is, if the American labs advance next year beyond their Chinese counterparts, how does that impact broader trade policy? How does that impact access to rare earths? Rare earths are very important to the U.S. War Department, so you're absolutely right. It is linked. There is this mutual dependency between the two nations, a mutual vulnerability, which actually makes me optimistic in the sense when you have situations like that, you can find equilibria given that both nations have dependencies on each other.
Stephen, both themes that we've been talking about, right? Let's talk about where the opportunities are. Let's start with sort of asset class divides in the capital structure, right? Yeah. Public market versus private with defense and industrial and also tech, right? A lot of the most interesting names and most innovation, they're still private market.
Yes.
Anduril, for example, has not come to market, and at I think last valuation I saw was about $30 billion, right? The company is hot enough that it probably never needs to come to market and to IPO. So how do you get a piece of that, or should we be talking to folks that can get us in on private market action?
It's a great question. We believe that private company research is quite important because you learn so much. You see evolving trends. You see where businesses are headed. What's interesting to me is AI democratizes many areas of the economy, including potentially defense, including weaponry, in the sense that smaller teams can use AI in very innovative ways. So we watch that world very carefully. A lot of what we see there in terms of autonomous weaponry, cybersecurity, it's quite innovative in the private world. So private research in Morgan Stanley is a big deal. We spend a lot of time because often it's an early signal as to where the world is headed.
Okay, public market though, that kind of access, outside of PLTR, for example, right? The defense primes, yes. They're huge still, right? Yes. But we talked about how their days may be numbered because this whole cost plus business model may be numbered. Do we write them off, or?
No, I think they have incredible technology capabilities. They have deep relationships. They actually do have very deep benches in terms of innovation. I do think the nature of those weapon systems may change, though. So, for example, back to this asymmetric dynamic, you have to think about vulnerability to things like hypersonic missiles. What parts of the U.S. military is very much vulnerable? You need to rethink what it looks like to be involved in drones. Do you want to spend a fortune on a handful of drones, or do you want to start to reduce the unit costs so that you can radically increase the number of drones. It's fascinating. There are some simulations of battles between different styles of militaries, and many of those simulations do favor this more dispersed, lower unit cost approach.
Right?
Exactly.
Yeah. All right. Stephen, listen, I really wish we had more time, but it's been great to talk. Thank you. Appreciate it very much.
Thank you.
All right, we've been talking to Stephen Bird, Morgan Stanley's Global Head of Thematic Research, as our coverage here at the Morgan Stanley Asia Pacific Summit 2025 continues. Amitash, back to you.
Thanks so much for that. And now the minutes from the Fed's meeting in October showed that policymakers remain divided about the central bank's policy path. Market expectations of a rate cut in December diving overnight. CME futures are now pricing in a 32% chance of a cut, dropping from 50% just yesterday. Meantime, President Trump continues to say he will fire Fed Chair Jerome Powell, calling him grossly incompetent.
Eggs are way down now. Mortgage rates are down despite the Fed. I mean, Scott, you got to work on this guy. He's got some real mental problems. No, he's something wrong with him. It's just sweet. I'll be honest. I'd love to fire his ass. He should be fired. Guy's grossly incompetent, and he should be sued for spending $4 billion to build a little building. I'm building a ballroom that's going to cost a tiny fraction of that, and it's bigger than the whole thing put together. You got to work on him, Scott. The only thing Scott's blowing it on is the Fed, because the Fed, the rates are too high, Scott. And if you don't get it fixed fast, I'm going to fire your ass, okay?
Coming up, India continuing to seek asymmetrical diversity among trade partnerships. Stay tuned. Welcome back. Now, India's Commerce and Industry Minister, Piyush Goyal, is leading the country's largest ever business delegation to Israel. The visit aims to deepen economic ties, promote trade and investment, and advance talks for a potential free trade agreement that the two sides have been negotiating for over a decade now. CNBC TV 18's Abhimanyu Sharma had just arrived in Tel Aviv and filed this report.
India's Commerce and Industry Minister Piyush Goyal is on an official visit to Israel. He's expected to meet Israel's Minister for Science and Technology as well as Israel's Minister for Economy Nir Barkat. In course of the next few days, there are B2B engagements expected between the Indian and the Israeli industry since a 60-member delegation from India from across several businesses is already present in Israel. There is also a likelihood that a potential FTA between India and Israel may also be discussed as part of the ongoing engagements. India is looking for more collaboration with Israel in several areas, particularly in areas of technology, innovation, wastewater treatment, and several possible joint ventures between both the sides. Now, several Indian companies are already invested in Israel and vice versa, and both the sides are looking to increase this engagement and possibly elevate this engagement by means of a free trade agreement between India and Israel.
So that delegation going to Israel, and Indian Prime Minister Narendra Modi, he'll be attending the 20th G20 summit this weekend in Johannesburg, South Africa. With US President Donald Trump boycotting the summit and Chinese President Xi not attending, the spotlight could be on Modi and India. The US has also officially warned South Africa against pushing for a joint statement at the G20 summit, reports Bloomberg. South Africa is supposed to hand over the baton to next year's host, the US. That might be awkward. India's focus is expected to be on inclusive growth, climate action, critical minerals, and of course, AI. Meanwhile, the IMF has forecasted weak growth for G20 economies. The IMF believes it will be its weakest since 2009, with advanced economies expected to grow by only 1.4% in 2030 and emerging markets by 3.9%. In the meantime, lots more happening. Afghanistan's Trade Minister Nuruddin Azizi arrived in New Delhi for his first official visit. The aim? Boost trade and investment with India as Taliban's ties with Pakistan deteriorate. The visit comes after India opened its embassy in Kabul and stepped up aid as both sides compete with China's growing influence in the region. Azizi will hold talks with India's trade and foreign ministers to seek access to food, medicines, and industrial goods, and push for joint investment and transit links. With a border closure hurting trade with Pakistan, Afghanistan's trade through Iran, including via India-operated Chabahar port, is increasing. India does not officially recognize the Taliban government, but both sides are recalibrating ties as regional dynamics shift. And coming up, we will take stock of India's financial sector as the country looks to open it up for foreign investment. We'll focus on banks. Stay tuned. Welcome back. This is Inside India. We're counting down to the market open in India. Just about 15 minutes to go. This is how we're shaping up at this point in time. GIFT Nifty futures indicating 26,137. Nifty 50 closed at 26,052. The benchmark is poised to open higher on Thursday, supported by returning foreign inflows. Nvidia crushing doubts and improving earnings. Outlook ahead of key U.S. jobs data expected today. And the Nifty 50 now less than 1% off record highs, set for a record peak after 12 months. All right, the Q2 earnings season has just wrapped up, and a look at India's banking sector shows a tough first half of fiscal year 2026, despite credit growth of over 11%. Banks reported muted profits, with aggregate net earnings up just 2.5% in H1, according to Indus Equity Advisors. The big drag, net interest margins continued to contract. The RBI has cut rates by 100 basis points this year, and banks have passed those cuts to borrowers, but their cost of funds is yet to fall, squeezing profitability, even as loan growth remains strong. Suresh Ganapathy is the head of financial research India at Macquarie Capital. He's right here with us in the studio. Thanks so much for joining us, Suresh. We don't always have you in Singapore, and we're really happy to have you here. Thank you so much for that. I want to start by just asking you a question about the big picture for our foreign investors who are obviously watching this, thankfully. India really intends to be a developed economy by 2047, right? To get there, the GDP must be 10 times larger at about 30 trillion. And the bank funding needs to rise by about, 130% of GDP, right? And the current is 56%. The regulators are considering easing rules. They haven't done it yet. What's your prediction for how this really shapes up?
Look, I think typically the credit multiplier over the course of last 15-20 years has been around 1.2, 1.3 times, right? So if you indeed see India's nominal GDP growing at about 10-11%, you can indeed see bank credit growing at about 12-13%. And I think we had a couple of tough years. The last couple of years have been tough in terms of the fact that there were some stresses in the unsecured space. The private capex is yet to pick up, but I think none of these things are permanent, right? I think some of these things are getting resolved. You've already seen the GST cuts and the tax cuts which have flown into the hands of the economy, resulting in a better credit growth in the retail segment. At least the anecdotal evidence has revealed that. So you will see a pickup in credit growth in the coming quarters. So you are back to about 13-14% kind of a credit growth for next financial year. It's been subdued this year so far, right? I mean, because there has been issue with respect to retail credit growth. There has been stress in the unsecured segment. The unsecured segment, Amitoj, has come down. The credit growth in that space has come down from a high of about 25% seen about 2 years ago, now down to 10%, right? So that's been a sharp deceleration. Mortgage credit growth has also been around 12%, but we have seen a cut in rates of 100 basis points. It takes some time for the rate cuts to flow into the economy because the rate cuts happen with obviously with a lag, right? In terms of lending rates in the system. So you can see a confluence of all those things coming together, resulting in a better credit growth environment, at least for the next couple of quarters. Even beyond that, if you assume that the nominal GDP goes back to 10-11%, note that we have also been, Amitoj, in a very low inflation environment. That is suppressing the overall nominal GDP and therefore the nominal credit growth. Once inflation goes back to 4%, you'll automatically see some of that inflation-linked credit growth coming back into the economy.
All right. I just want to understand this because you've spoken about downside risk, but is there any source that you can speak to of downside risk from a risk in non-performing loans actually going closer to the record lows that we've seen in the past?
So look, on the non-performing loans, things are definitely much better today than what it was 6 months ago. You are clearly seeing signs of the NPL levels picking out. We are anyways, if you look at over a 15-year period, much lower, but we had a slight uptick over the course of last 6 to 12 months because of stress in certain pockets. That stress only remains in certain pockets. It is not widespread at all. And you are clearly seeing signs of some of that stress actually abating in some of those controversial segments like unsecured loans or unsecured business loans. So things are perfectly fine on the unsecured NPL front, where if I were to really answer your question on downside risk that you see specifically for the banking sector, profitability wise, could be the fact that currently the market is factoring in a 25 basis points of rate cut.
Are you also?
Yes, I am also in the same camp. But inflation has been low. Now, I don't see RBI making a policy error, but if indeed they go about cutting the rates by, say, an additional 50 basis points, that means you're talking about an additional 75 basis points. I don't think either the market is factoring in or any analysts are factoring into the financials. And
haven't heard that at all.
Then, exactly. Then you landing up cutting your margin estimates, and therefore you see a downside risk to earnings growth. That is not in the base case numbers at this point in time.
Okay. So I just want to get clarity on this about the banks and the margin profitability.
Yeah.
That is likely to get affected.
No, that is likely to get that is likely to improve over the course of coming quarters because they have already gone down, considering the fact that the loan yields have gone down, as you rightly said at the start of your conversation.
And if the RBI cuts, then
if the RBI cuts more, then it's a problem. But if the RBI doesn't cut more,
it's not going to improve by much, right?
No, it will improve by at least 15 to 20 basis points from the current levels because you have a lagged repricing of deposits, which will happen over the course of next 3 to 4 quarters.
Okay. I just want to go across to what the finance minister said recently, right? Again, just zooming out to understand the Indian banking landscape.
Sure.
She's vocally said this, that she's in discussions with the RBI to address the need for an ecosystem for nurturing world-class banks.
Correct.
Which effectively is something that India is kind of lacking because there are only two, SBI and HDFC, that rank in the top 100 global sector list by total assets. Now, what primary challenges could this effort face? And if it is to happen, how much time will it take?
No, look, I think in 2019, the government engendered the first big wave of consolidation, and they did brought down the number of public sector banks. I do believe that it is realistically possible, provided if they really have the intent to bring down the number of public sector banks, if I'm not wrong, from the current 10 to 4 to 5. They may not necessarily touch SBI, so SBI will be untouched, but the other banks, like...
It's too big now.
It's too big, and secondly, you know, something which is doing well, SBI has been doing pretty well. You don't want to force it through a process of a merger. Secondly, where are you going to get the economies of scale when you're already at a 25% kind of a market share, right? So it makes more sense to bring about the other public sector banks together and merge them into a top 4 or 5 banks. Also know that, Amitosh, there has been a perennial challenge of finding the right talent to run some of these institutions, right? So, I mean, the CEOs and the CFOs and the executive directors all get appointed within the same public sector banking ecosystem, and there is just a musical chair that keeps getting played. Like one bank's ED goes as the CEO of another bank.
Why can't that be fixed?
No, because at the end of the day, there are government considerations.
I see your smirk right now.
No, I'm smart. Look, these things are a little bit controversial. I'll tell you, one of the main reasons here is that you cannot really pay market-linked salaries. And the salary level of a public sector bank has to be necessarily in the same line of a bureaucratic level of salary. So how do you land up paying, say, $1 million salary and recruit a guy from a private sector to run the organization? So very clearly, it becomes very difficult to attract talent. It has to be within the system, within the PSU ecosystem. So if you bring it down to 4 to 5, it's easier than finding out talent for 10 people, right?
Okay, so that's one of the primary challenges according to you, right? Just explain this to me. Will this be something that will be a blessing or a curse for private sector banks, this consolidation?
Look, I think if it improves the overall efficiency of the system, so be it. It's good, right? At the end of the day, more efficient banking system is always a welcome move from an overall system perspective. But if I were to really look at it from a very near-term perspective and take a very myopic view, then what exactly would happen here is that few large public sector banks can be well equipped to grow faster, and therefore to that extent it can be a little bit more challenging for the private sector banks, because the narrative has always been that the private sector banks have 35% market share, the PSUs have 60%. The 35% market share can take away the market share from the remaining 60%. Somewhere down the line, if you believe that consolidation is only going to make the public sector banks stronger and more efficient, then obviously a little bit amount of that market share grab which the private sector banks were supposed to take becomes a challenge.
No, what do you believe in this? What's going to happen?
No, it's not going to be easy. Look, I still believe private sector banks are expanding. They are better in terms of technology. They are efficient. I do believe they will continue to nibble away market share from public sector banks over the longer run, because at the end of the day, remember that you're only merging. I mean, I don't know what kind of an analogy should I give, but
blessing or curse for private sector banks?
No, I don't think it's going to be a curse. Okay. It's very clear about blessing. That. It's soft blessing. You can look at it in that way.
Yeah. Which is blessing in India.
Yeah.
Okay, all right. There's something that I want to bring up, because this was reported by Bloomberg.
Sure.
There's a work in progress in India to allow direct foreign investment in state-run banks of up to 49%, more than double the current limits.
Correct.
How do you view this?
Look, I think See, at the end of the day, the control still remains with the government. Note that they are not planning to take a majority stake. The majority stake will still be with the government, that is basically above 50%. So very clearly it means that the controls and the processes will still be bureaucratic in nature. The FI investment just is another avenue to bring in more amount of foreign capital. Just to give you some perspective, even today when the foreign holding limit is at 20%, it's hardly being fulfilled. So raising it to 49% doesn't necessarily mean more FI interest if they're not going to get the control. So the only thing where it really helps, at least in the near term in my view, is that it helps these PSU banks to get included in various indices like the FTSE or the MSCI and stuff, because you open up the foreign holding limit and therefore it attracts a foreign flow from passive funds. Otherwise, from an operational or an efficiency standpoint, I don't see a reason why, because it's already the limit is available at 20% and you're not seeing that limit is being utilized. So I'm not sure how much 49% serves the purpose.
Just remind me, why is it not being utilized?
That's because the interest in the public sector banks is low. People want private sector banks than buying some of these public sector banks. I have been marketing.
Is it because of the bureaucracy?
Bureaucracy, it's also the question of efficiency, right? Efficiency, transparency, profitability. More importantly, it boils down to fundamentals. You are getting private sector banks who are growing much faster, gaining market share, better profitability. So the only interest largely has always been from the foreign investors. I have been doing road shows over the course of last several years, and even now I've been on a road show. The only interest has been largely in SBI, the largest public sector banking in the system, largest public sector bank in the system. Otherwise, largest bank also. But anything below SBI, the interest still remains pretty low from foreign investors' perspective. So yes, opening up from 20 to 49 could be a good for SBI. So clearly for them, it's going to be a blessing.
Okay. There's also this other idea on the same lines that may allow lenders to directly fund corporate takeovers.
Yes,
Still in the
M&A.
works.
Yeah.
Still being discussed. What's your view on that?
Yeah, look, I think it opens up an incremental opportunity. I was just speaking to a senior banker and was saying an annual opportunity could be to the extent of about $5 to $6 billion for the Indian market. But if you look at it in an overall scheme of things, India's loan book is in trillions of dollars, right? So, so my point here is it doesn't really add to the credit growth in a very big way.
Yeah, but it's these small steps.
It's a small steps, that's right. So it's a step in the right direction. You're opening up the market. I think the broader messaging, Amit Tojaria, to take here is that the Reserve Bank of India has been far more open when it comes to its stance in trying to regulate some of this banking system entities. And that openness is a very welcome move, because that opens up a lot more amount of opportunities for a better credit growth. So it boils down to the same question that you asked at the start of the conversation. All these are enablers in the longer run to get to that so-called $30 trillion GDP.
Okay, let's try to see if we can squeeze in 1 minute 2 questions. Okay, how do you view the statutory liquidity ratio that obliges banks to hold that prescribed ratio? Currently at what, 18% of their assets in the form of gold or government bonds, right? A recent argument by Indian economist Swaminathan S. Ankalesar Iyer suggested no modern economy has anything of the sort, and it should be abolished if India has to get to that 2047 advanced economy idea.
Enough.
So what's your view?
Who will fund the government's fiscal deficit? Unfortunately, that's the problem, right? So unless and until this is accompanied by a very sharp fiscal consolidation, I really don't think this ratio number is going to come down. Unfortunately, there is a big issue when India still runs a debt to GDP at the central level at 57%, at the consolidated level maybe above 83, 84%, and the fiscal deficit is still running at about 4.4% for this year. So we need banks. Banks are 50% of the overall funders of the fiscal deficit. Unless and until this number comes down substantially, there is no room for the government or the RBI to cut this any further.
Finally, very quickly, JP Morgan CEO Jamie Dimon warned just a couple of weeks back of cockroaches lurking in private sectors. Is there any concern like that in India?
Not at all. I mean, we have had a look at it. The private sector credit market, the private credit market, is at about $25 to $30 billion. Very small proportion as a proportion of the overall banking system loans, less than 1%. As a proportion of corporate loans is less than 1.2%. So it's still very small, very much in the nascent stages when it comes to India. So even if there are defaults here and there, the system can easily digest and nothing much to worry on that.
All right. This is the most positive I've ever heard you about India. Thanks so much for that. It's lovely to have you here. That was Suresh Ganapathy from Macquarie Capital. Coming up, Indian markets have just joined the trading day. We'll look at some of the movers in Mumbai after a very short break. Welcome back. The Indian markets coming online, the Nifty 50 looking positive, as has the rest of Asia. It's in the green, and this is keeping in mind everything that's gone on in the US. Nvidia concerns, all gone, all out of the AI bubble. Not really there, according to the man who runs Nvidia. And what you're seeing on your screens right now is the positivity filtering into the Indian market. There's a lot to look forward to. There's that Thursday jobs data that's coming in, and that might perhaps take Nifty 50 even higher. We'll have to see on Friday. But at this point in time, what is the basic concern? The concern is that whether Nifty 50 will maintain its momentum and get to its record high above 2100. That's the key question. The US dollar and Indian rupee. The Indian rupee continuing to be weaker against the US dollar. The RBI's interventions will be something we'll be watching out for. It has been doing that quite a lot to maintain that psychological barrier of 88.8. It doesn't want it to go over that. All right, now the power regulators of India's northern state of Uttar Pradesh has delayed approving a major power supply deal tied to Adani Group's new $2 billion coal power project. The regulator has cited a gap in cost details. Adani Power won the contract in May to deliver 1,500 megawatts of electricity, but questions have emerged after the Indian government eased rules in July, allowing certain coal plants to avoid sulfur dioxide removal technology. According to the regulator's order, Uttar Pradesh, one of the states out there, a largest state in India, Power Corporation there, did not provide its own assessment on how those savings or cost adjustments would affect the project. The commission has now ordered the utility to make Adani Power a party to the case and submit a full cost assessment within 2 weeks. A quick check on the shares of Hyundai Motor. Take a look out there. It is positive. It's been positive for a while now. 1 year, 32.50% up. And Martin Sung spoke to the company's COO, Tarun Garg, right here in Singapore this morning. He told Martin that since becoming a listed company last year, Hyundai India's investors also focus on the export pipeline and how the company navigates competition from Chinese players. Here's a part of that conversation.
India is a very big export hub outside of Korea for HMC, and we are basically an hub for emerging markets because the markets are similar, the economies are similar, the customer choices are similar. So in fact, right from the time we set foot in India as Hyundai, we have really focused on exports, and this year especially exports have taken off, almost a 17% increase in the H1 of this fiscal in export volume. So we are exporting to Middle East, Latin America, Asia, Central and South America. So I think the sales are only going up, and we export all models. So I think the best part is that we first launch the car in the domestic market, we scale up, and then we launch it in the export markets. And just to tell you, a new plant we have made in Pune, which has increased our capacity. So far we were operating at about 824,000 capacity, but now 170,000 has been added. So now we have a lot of headroom to really increase exports further.
Tell me, the brand or the brands that everybody fears in the auto market right now are Chinese brands, the Chinese EV makers. Nobody can make an EV cheaper, bar none, right? It's a pretty weak market at home in China, we know. They're all going outbound to try and keep from their market share slipping at home and their margins slipping at home. And the rest of the world is getting increasingly nervous, right, that the Chinese EV makers are out to basically eat their lunch. Have they arrived in India?
So not yet. I mean, yes, of course, we have a BYD and MG in India, but India is not a very easy market to crack. As we know, the global OEMs, generally have not done so well in India. So the same thing about Chinese as well. Because, in India, it's also about the dealer network because, like, for example, 25% of my sales happens in the rural areas. So you need to set up a network. So Hyundai has taken probably 3 decades to set up a network like that. Even today, 3 out of 4 outlets which I make are in the rural areas. So we are really building a very, very comprehensive network, great customer service, not only in terms of mechanical, but also body shop, the customer experience, the whole brand thing, the CSV. So I think it's not only about sales, but it's a very 360-degree customer experience that we are very proud of and which we feel gives us a very good, edge against any competition. So, yeah.
Against any competition. So let me ask you, Tarun, let's, for the sake of argument, let's say we're talking about a market like Hungary. Pretend I'm a Hungarian national, right? I meet you and I go, oh, okay, you work for Hyundai. You make cars in India, Hyundai's in India, and you ship them to places like my country, Hungary, right? Where Chinese cars are also available. price, model for model, car for car, how competitive would a Hyundai be against a Chinese EV in Hungary, for
Look,
example?
if you see for us, because we are not exporting so many EVs, we are, still ICE dominated as far as our exports are concerned. So Hyundai has a very strong legacy, very strong brand in the emerging markets, in the Middle East, in the Latin America. So we get a huge advantage. So EVs are still maybe a couple of years away, because we are still exporting EVs only to, say, the nearby countries. We are not really exporting. So there, it's an inherent advantage to HMI. Brand is very strong, and the dealer network, and we are really focusing on after sales. So I think that is really giving us an edge, and that is why we are able to navigate these challenges much better than the others. EVs are still maybe a couple of years away as far as exports are concerned.
All right, a company document reviewed by Reuters shows Air India is urging the Indian government to push China for access to a sensitive military airspace zone over Xinjiang. The Indian government is currently weighing the airline's request to approach Beijing for an alternative route and emergency landing access at airports in Hotan, Kashgar, and Urumqi routes that would help restore faster connections to the US, Canada, and Europe. Air India says the route would significantly shorten long-haul flights as the financial impact of Pakistan's airspace closures continue to weigh on the carrier. According to the document, fuel costs on some routes have surged by up to 29%, while flight durations have increased by as much as 3 hours. Air India estimates the airspace closure is hitting its annual profit before tax by about $455 million. The appeal comes shortly after India-China direct flights resumed, ending a 5-year suspension. Meanwhile, Indian seafood exporters surged in trade yesterday after reports that China had notified Japan of plans to suspend imports from the country. And well, Japan's loss could be Indian suppliers' gain, who are already taking a hit from steep US tariffs. But what actually is happening between Japan and China? Elaine Yu joins us now to tell us more about that. Elaine?
Hey, Amitosh. So yeah, tensions are spreading to seafood now. A Japan official said the country has been notified by China that it will be suspending seafood imports because of allegedly insufficient radiation inspections. And when asked about this, the Foreign Ministry of China says Japan has been so far unable to provide guarantees of quality and safety. And she also said that there is, quote, strong outrage and condemnation from the Chinese people over Takaichi's, quote, erroneous remarks. And under these circumstances, there will be no market, she says, for Japan's aquatic products, even if they enter China. Now, the context is that China banned these imports 2 years ago after Tokyo decided to release radioactive wastewater that's been treated from its Fukushima nuclear plant. And China only partially resumed shipments earlier this month, actually. But there are also signs of a broader economic fallout. A Tokyo-based travel agency says that 70% of group tours have been canceled from these Chinese tourists. And there are also state media saying that 2 Japanese movie screenings has been officially delayed. But we'll see if this does become an opportunity for India, with the U.S. and China both being top destinations for India's shrimp exports, so much that U.S. senators have previously pushed an India Shrimp Tariff Act when trade tensions were escalating between the two countries. Beijing is demanding that Japan retract these comments, saying that otherwise China will have to take further measures. But the off-ramp does look very tricky here, with more economic retaliations that have been widening. Amitosh.
Yeah, finally an on-ramp for one sector in India. Appreciate that so much. Now, U.S. futures, let's take a look at that. Still up strongly thanks to NVIDIA's bullish earnings outlook after hours. Well, implied open up 1.29% for S&P 500. 0.56% for Dow Jones, Nasdaq 1.85%. We could also see more tailwinds coming from reports that the White House is asking Congress to reject a defense bill that would curb AI chip export restrictions to China. NVIDIA, of course, would be a big beneficiary if that would happen. Its shares have already been up 5% in extended trade post earnings, 5.08% to be sure. But we're watching that and more. But for the moment, that's all the time we have. This is Inside India. Keep watching CNBC. Access Middle East is up next.